Well, g'day there everybody. Thanks a lot for joining me as at this Thursday afternoon market recap. It has continued to be, relatively speaking, a tale of two tapes. Here is the chart of the Dow Jones Industrial Average. Again, it printed a positive number up just over 20 points. The S&P and the Nasdaq, however, continued to retrace, which is showing us initially a little bit of market divergence. Now, this is becoming concerning as we look at these oscillating indicators. Now, we've been picking up on this for quite some time. We have remained relatively overbought for a prolonged period of time, but what is interesting about this is that they are beginning to give us those crosses, those bearish crosses, and also beginning to move out of, again, overbought territory. Pay attention to the stochastics, which the fast line itself is just pushed below that 80 figure. The RSI has adjusted over the past week and a half out of that overbought territory. And most importantly, of these three oscillators, the MACD has now given us a definitive cross. Now, looking at these in and of themselves, it's not enough to suggest that, look, we are on the precipice of a major reversal, not until we see a couple of more details actually crack, or at least set up and then crack. One of which is the confluence of support, which is showing up on the S&P 500 and the Nasdaq. Now, in tomorrow's pro class, I am going to go into this in more detail, but what you need to pay attention to on the S&P 500 and that of the Nasdaq composite is that of their horizontal support areas, old resistance areas that we have just most recently pushed above, established a new all-time high, but at the same time are coming to at least come back down and retest these areas. Now, I've picked up on the fact that this is looking like some form of an extended bear flag across the board on the S&P and also the Nasdaq. However, what is interesting to note is that the Nasdaq is selling off quite aggressively compared to that of the S&P 500. Now, again, very similar to what I just showed you on the S&P 500, on the Nasdaq, we are more so at a critical area. You can see on my screen that we are more or less sitting on my actual resistance area and also support area of around 7,930. We actually closed at 7,923. But you can see that we do have a little bit of a lower wick. Now, with that wick yesterday, it didn't really stop the selling pressure. Again, we closed down 71, or very close to anyway, 72 points. But this area, essentially where we are at the moment, with this rising intermediate bullish trend line, is technically support, and so is this horizontal area where we more or less closed at. So the critical question you need to ask yourself at the moment, and before I share with you that critical question, the what if scenario, I just wanted to show you these oscillating indicators on the Nasdaq as well, because there is a chance that this breakout is out of a false move. You can see the Stokes. It isn't as, I guess, further down the road as what the S&P 500 stochastics is showing us. We are still technically above the 80 line on the fast signal here, but the RSI is certainly dumping. We've also seen that of that sell signal on the MACD begin to cross down. Now, one of my favorite technical indicators when it comes to trend breakouts is that of the ADX and the CCI. When you see a trend breakout after a range of consolidation, and I'd like to pose the question right here, right now, that we're not technically in that of a consolidation. Generally, when we're talking about consolidations for the CCI, the Commodity Channel Index, and the ADX to work, is that we want to see more or less a sideways stagnant moving market for a number of months. Now, generally, I like to use this over about a 3-month period. However, you can make, I guess, a general assumption that this is some form of a consolidation, but it doesn't really fit the narrative of how we would generally use the CCI and the ADX. It's too much of a prolonged sort of time period. And also for the Nasdaq, we have technically been making a series of higher highs and also higher lows. It doesn't work as well on the Nasdaq. Now, again, if you wanted to use the CCI and the ADX, you could say to yourself, well, technically we have been in some form of a consolidation. The range of this consolidation isn't, I mean, it's too large, so to speak, to be considered that of a sort of a CCI type of breakout. We have moved most recently from 2,600 all the way back up to 2,850. Prior to breaking out, the CCI, it is going to be extended. However, what you're seeing right now is the CCI snap back down, and it's looking to move below that positive 100 print. If you see this on the S&P 500, and if you see a dark Morobozu candlestick with the ADX turning up, that is a very strong signal, and this is really the crux of the argument, or at least the analysis as at this Thursday. If you see that, and I'm not suggesting that it is going to happen, but we always like to keep a rather neutral outlook on the markets, well, then you can assume that this intermediate trend line is going to be tagged, and the odds of this actually breaking go up exponentially. The reason I say that is because we'll look back in retrospect and we'll say, well, that was a false breakout. And again, we've been largely speaking about this and very wary of this on the S&P 500 and the Nasdaq. And the reason for that is because we're not seeing market confirmation. We're not seeing market uniformity. And what I mean by that is the Dow Jones Industrial Average is still yet to break out above its respective all-time high. You can see this figure up here at 26,500. So again, this comes back into our state of sort of bifurcation on the overall market indices. We've got the Dow Jones, which is trying to do everything in its power to move all the way back up to resistance, whereas the S&P 500 and more specifically the Nasdaq is looking a lot more shakier, especially when you factor in, of course, these oscillators, which are suggesting some short-term weakness depending on whether or not that CCI and the ADX turn up and down respectively. All right, and the same is true for the S&P 500. I cannot stress enough right now just how important these intermediate trend lines are, because what will happen is, say for instance, we do see the pullback, a deeper pullback, and we get down to this critical area. Let's just call it 2,800. All right, I'm trying to write here 2,800, and let's just say we begin to flinch below all of this short-term support here, 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 and a little bit over here. What that will do, technically speaking, is open up the door, and this is going to come as a shock to a lot of people, is that it opens up the door for the S&P to come all the way back down to 2,675, all the way back down to 2,600. And a lot of people will be shocked by that, but that is certainly a very realistic sort of scenario at play potentially at the moment. We may be on the precipice, so to speak, of a larger intermediate corrective move lower, but at the same time, we need to see certain things establish themselves. For the time being, however, we are still technically long in the market, but we are extremely cautious, and I cannot stress just how important this upper area of support is on the S&P 500. And if you pay attention to this on the Nasdaq as well, you can see that we're a lot closer to actually influencing and interacting with this rising trend line than what we are on the S&P 500. So pay very close attention to the Nasdaq to see what happens around this 7,000. If I can use my illustrating tool, my mouse here correctly, 7,800 on this rising trend level. Also pay attention again to these breakout signals suggesting potentially that of a false whipsaw at play to the upside, which is going to catch out a lot of longs. And also that confirmational market is that of the Dow Jones. Until the Dow Jones breaks above its resistance area, or until it closes the gap and continues to confirm the most recent highs on the Nasdaq and the S&P 500, there is just a tremendous amount of risk on these markets. And I want you to be very much so made aware of that. We've been speaking about this for a number of months, ever since the Dow did hold support, and it has been in this really sort of slow grind to the upside. It has been a relatively frail sort of rise over the past number of months. And considering that, it is looking a little bit shaky. I think we can all agree that these markets, so to speak, especially over the past week or so, potentially are starting to print a different type of sentiment to the actual candlesticks. We are seeing a series of dojis and hangmans and spinning tops, not to mention one black crow type of candlesticks. But at the same time, I've also posed the question, well, we could just see a breakout, a very short-term breakout on the S&P and the Nasdaq, as the Dow Jones comes on up and tries to push and close that gap. So I just wanted to break down the markets. Generally what happens is when the markets are not in agreement like they are really at the moment, at the current juncture, generally what you should do, all right, if you're a technical swing trader, is just stay away. That's really the short explanation as to what is generally the best case, or at least the best option for you to do as a technical swing trader. The reason for that is because the consensus is really confused, and you'll see that when you begin to see divergence between markets, and that is exactly what we are seeing and are continuing to see really throughout the period of July and also August. So be very strategic in your entries if you choose to jump into some new positions. Obviously, when it comes to tech companies, they have been routed recently. We have been very cautious and observant of this. In fact, we have largely stayed away from a lot of these companies. The positioning in these companies was actually a couple of weeks ago. You can see on Apple, retrospectively here at 210 and 219, the dash line is never a trade that we are looking to be in. However, you can make an argument to do such a thing. And essentially what we've been doing is just moving the stops up with these tech companies. So there's no open position on Apple. Amazon, you can see we were gravitating around the psychological round number of $2,000 per share. In fact, we sold our most recent positions at $1,990.32. Again, a lot of people jumping into Amazon above 2,000, and then over the past 2 days, it gets smacked back down to reality. We're closing right now just below $1,960 per share. If I move into Boeing Airlines, we spoke about this over the weekend. We were talking about a little bit of weakness coming into Boeing Airlines, which was going to create the neckline upon which we will short at a later date, and we were expecting a very short-term bounce, probably back up to about 356. Well, that is exactly more or less what has played out on Boeing Airlines. So essentially right now we've got a defined neckline, and now this on Boeing Airlines becomes a short. It may not make much sense, I guess, to the sort of the untrained eye, but if this comes on up back to 355 and then you begin to see dark engulfing candlesticks, you've got a very nice entry on Boeing Airlines that's going to be positioning you in, hopefully at about 350 with an option to add at about 340. And the target on this at minimum is going to be down here at 320. So this is going to be a fantastic trade when it is ready. There might be a little bit more juice in the tank or gas in the tank, so to speak. But really what we've been expecting to see on Boeing Airlines is exactly what is playing out during this abbreviated week's worth of trade. I wanted to point that out to you on Boeing Airlines. Stay patient, stay hungry, and be ready to enter when the time is right on Boeing Airlines. Baidu is coming back down to its support area at 215. We've been expecting a little bit of market noise on this stock. And what's interesting about this one is that, well, if we start to see a reversal more or less from this print, then it will begin to establish that of a W for a double bottom, which is really why we're expecting the price of Baidu to come up to 245 over the coming weeks, all right, or even potentially a month or so. If you're in this trade at 222 or 226, place your stop, all right? It is a really nice risk and reward sort of ratio on this trade, but at the same time, think about that discussion we just had when it comes to the market indices themselves. Caterpillar still largely going nowhere. You can see we're just simply moving sideways. But the good news is that every day, more or less, we get stuck moving sideways. It's a day closer until we get a definitive answer one direction or another. What you need to be paying attention to on Caterpillar is out of this bullish rising trend line, very similar to the discussion on the S&P and the Nasdaq, whether or not we hold above this. As long as we hold above, all right, roughly 134 to 132, anything above this area, above the trend line, over time, you can expect Caterpillar to come back up to 155. If we crack definitively below this area of support, all bets are off, and Caterpillar, there's a very high probability that we're going to come all the way back down and close this open window in the month of July 2017, which will take us down to 105. I know that sounds a little bit crazy, but it is certainly a very realistic, all right, probability and chance of playing out if we see weakness in the markets, i.e., a deeper correction. We've got COP again beginning to roll over up and around this resistance area. Very hesitant about these trades. Again, after the market analysis, waiting for the Dow to close its window, potentially seeing whipsaws on the S&P and the Nasdaq. We'll have a look at COP down $2.46 today, very close to 70.45. Keep an eye on that. We don't have market confirmation yet, i.e. we're not seeing any real major sort of material selling pressure yet, but it certainly is there, or at least you can make the argument very clearly that we may be very early on in this intermediate correction. Time will tell. We'll have to pay attention to that. CVX today cracking down to our target at 115.23. Now, I understand if a lot of people, i.e. the majority, if not everyone, liquidated the position more or less for a break even over here, but you can see it just took a little bit more time, all right, to get down to our originally stated target. It was looking as if we were going to do this in the midsection of August. It just more or less stopped, it reversed, it came back. We spoke about this, it's produced another lower high, and now we're back down at support at 115.23. So I'll speak about that again over the weekend. Google has overshot this area of support, which is very interesting. Down another $15 today. We do have 2 consecutive long lower wicks, so I'm still expecting the support area to hold, unless we see the Nasdaq itself crack below that intermediate area of support, that trend line that I showed you previously in the market analysis. So pretty much I'd be sitting on my hands with Google at the moment. I know it's not looking all that good in terms of its retracement. It has overshot that support area, but the candlesticks themselves, they do have lower wicks. Pay attention to that. It is relatively mixed. We're seeing, short-term oscillators into oversold conditions. The MACD is still technically bearish, and the Stokes is beginning to give us a cross down from that midpoint, which is a very interesting signal. And I mean, if you look at this, you could make the argument, although it's not a very strong case, that we do have a leaning triple top. I don't want to call it that, because in my opinion, it hasn't taken enough time to actually produce that. When people really look at things or at least on a very molecular type of level or fractal, you can really make anything begin to appear. It's not until it becomes really obvious on the daily time frame and it satisfies criteria of length, okay, and proportionality, where you get the true sentiment mix, or at least the true sentiment sort of shift that takes place during those terminal reversal patterns that do set up in the way of double tops or triple tops or head and shoulders patterns, those types of things. IBM, very similar to Caterpillar, largely moving sideways. It hasn't really gone anywhere, which is interesting. Netflix, we were stopped out of this earlier in the week for a pretty decent profit on this, right? We were talking about culling positions, being happy with the profit. Maybe you have some of those positions, pardon me, still open. I think I was suggesting maybe 30 or 40% to hold on to, and selling about 60 or 70% up here at 366. We've pulled back down to 346. This is still about $17, $18 above the original long price at 328.90. This, I would make the argument, is holding up better than Google, but at the same time, it is under weakness. I wouldn't be doing all that much on Tesla at the moment, except potentially just liquidating those final 30, 20, 30, 40% of positions if you're still holding them. You can see here on Tesla, it's back down at the support level at 280. Again, one of those stocks I'm not really navigating around or towards, or really looking at the moment. I do think ultimately we are going to crack these lows, but before we get there, we can see another rally, which sort of fits my longer sort of intermediate perspective on the market as to a retracement, a bounce to close a lot of these open windows with a bunch of tech companies as well. And it's a pretty decent segue to go into Twitter and also Facebook, because we've been speaking about these coming on up and to close these open sort of windows. We haven't actually seen that form at the moment. We had a pretty decent basing pattern at about 32. A lot of these social media companies at the moment are getting absolutely belted. It's almost like a second wave or a secondary wave after the initial reaction, the shock and awe, as to a lot of their earnings, or at least the reaction to their reports. We started to see that bounce, but we didn't really get anywhere. We didn't really gain any traction. And we're starting to see a little bit of divergence between Twitter breaking to the downside and that of the Nasdaq, still more or less up, very close to its all-time highs. So we're starting to see a rotational shift out of certain companies into others. However, what's interesting to note is that the composite index is very close to, again, just to recap, its all-time high. So we are starting to see Twitter move down $1.92 today. We're still generally in the vicinity of support, which is good for this stock. And the blatantly obvious thing to see, okay, whenever this bottoms out, is that we are going to close this window. If we see this happen, all right, if we see this window open for an extended period of time, the magnet just grows. Okay, it's very rare not to see windows close, especially as large as this particular window here. So we could see some rather irrational selling, so to speak, a lot of people jumping on board with what seems to be a dead cat bounce. But at the moment, I wouldn't be reading all that much into it. Always trade with stops, but it's not enough to suggest at the moment that the macro trend on Twitter has actually changed. Now, if I bring up that of Facebook too, you can see this is a very, very interesting stock for a number of reasons. One, we were trading at about $220 a share just as recently as about 1 month and 1 week ago. You can see that after earnings, very similar to Twitter, we've gapped down to 170. We've tried to bounce, we've failed. We've tried to bounce, we've failed. And now what is critical, if I can show you this on the weekly chart, is that we are now technically sitting right on this very important area of support. Pay attention to this. We're trading at 162.53. This is a very long-term trend line to pay attention to. In the past, every time we have come around or got close to this area, we have seen, whether or not it has been immediate or over a number of weeks, an actual reversal. Now, the picture on Facebook is ugly. I get that, but at the same time, we've closed on this level. We've got a lower wick. Pay attention, okay? Pay attention to Facebook, because if you start to see white candlesticks develop, I'm suggesting that there is a fantastic risk and reward ratio on this trade if you place your stop. And I do stress, okay, placing a stop, because if this trend level goes, this is going to be under significant pressure, but you do have limited risk, so to speak, to make a pretty decent reward on the trade based off, okay, the idea that a trend is in effect until it's given us definitive signals that it has reversed. And really right now, we don't have definitive signals, although we are seeing, again, gaps in a lot of these tech companies. We are testing that of the bull market uptrend across the board. If these trend levels go, this could be a leading indicator. Facebook, Twitter, a bunch of these other tech companies, that a larger sell-off is about to sort of happen moving forward in the near future. But until that happens, again, rounding this back into the Nasdaq, it's very important that we hold these levels. If we don't, you're going to see the market retrace. It's going to retrace hard, and it's going to shock a lot of people. So please be very selective. For those of you who are swing traders, who are looking at analysis, understanding the risks involved with buying this market on this pullback at the moment, or for the time being, I would suggest until we see confirmation of a break and a continuation to the upside after this bull flag, I would be watching this from the sidelines and waiting for an opportunity to trade short on the market indices, okay, if they do establish and break these levels. And that's really my take on the markets at the moment, okay, where we find ourselves, where we fit in the overall market analysis, all right? And I just wanted to point this out. This will be the final piece of information. Again, left field analysis, a little bit creative at the moment because the picture isn't formalized all that well. But imagine if this process here was some form of a left shoulder. Over here is some form of a head under construction that, again, we're just simply unaware of. Imagine if we do see the market come on back down to about 6.9 and then we see a rally into really the first half of 2019, which then reverses at a later date at around 7,500. I'm just floating the question here. It's going to look something like this. Okay, chop, 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 support, bounce, lower high over here. That would be a very, very, very concerning picture. So what is happening up here, okay, is incredibly important. I know it's creative. I mean, no one has the answer to this, but I'm just floating a piece of analysis that I find relatively interesting, or at least chart analysis as to what could plausibly play out. All right, so that's going to do us as at this Thursday. I wish you all a very nice evening, everyone. It's James signing off on behalf of Pivot Point Trading. I would encourage you to have a look into that pro analysis class tomorrow if you do have time. All the best. Goodbye.